Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hey everybody, Dave Bartosiak here with your top stock pick of the week. And no, it's not Nike, but I am going to touch on Nike here shortly. It's actually Foot Locker is going to be what I want to pick. But why am I bringing up Nike? Well, I'm not sure if you all were paying attention, but Nike just had a huge earnings report, an 82.35% surprise, with EPS coming in at 93 cents, crushing estimates calling for 51 cents. That's a difference of 42 cents. Now, in their call, Nike mentioned Foot Locker was one of their preferred partners. So this is what I want to talk about today is a Foot Locker, ticker FL. They are a Zacks rank #1 strong buy. We also have some pretty decent style scores here. We have a B for value, a C for growth, and a B for momentum to help it round out with a VGM composite score of B. Now, the retail, apparel, and shoes industry is in the top 21% of our Zacks industry rank. Of course, talked about Nike. Let's take a look at the numbers here. Now, sales growth current year, monstrous, 11.24% for the year. Next year, that's supposed to reel in a bit down to 1.56. Current year, look at this huge EPS number, 101.42% year-over-year growth. Very impressive. Next year, again, that's slated to reel in just 2.16%. But really, the story here has been estimates. If you look at the last 60 days alone, 5 analysts have upped the ante for the current quarter, while 1 has been on the opposite end. And it's kind of funny if you look at the next quarter, it's the inverse scenario where 5 folks have cut and 1 has gone to the upside. But really, don't worry quarter to quarter. It's all about year to year. 8 analysts increasing their estimate for the current year and for next year. What's the impact to our Zacks consensus estimate? Well, we went from 468 all the way up to 566 for the current year. Next year, from 517 all the way up to 578. Those are great bullish moves there. The last thing I want to touch on, the strongest, most impactful and powerful chart that you can use on Zacks.com, the price, consensus, and EPS surprise chart. Now, the black line here corresponds to the right y-axis, which is price. These multicolored lines represent the evolution of our Zacks consensus estimates, and those correspond to this left y-axis. The little green arrows are earnings beats, red arrows, earnings misses. Now, here's what I want to show, is this trough coming out of 2019 into 2020, earnings take a tumble, but then they bottom out and really ratchet up. And you can see that not only in the current year estimates, but next year's estimates, and now here even into 2022. This is definitely what you like to see, this sort of up, and away in these earnings estimates. The price tends to track along with estimates and earnings. So as long as this keeps moving in a positive direction, you're going to see continued momentum here in Foot Locker. And look at this, just a beat, a beat, a beat, a beat. So you've got some earnings momentum going on here. We got the nice Nike story that's helping, and everything pushing up to the upside. That's why I'm naming Foot Locker my top pick of the week. But there's more here from Mr. Dan LeBeau. He's got an idea for you too.
Thanks, Dave. So today we're talking about FedEx, and FedEx has just had a absolute tear since its pandemic lows, over tripling in price, and I think we're still at a pretty equitable value. The stock's only trading at 13 times price to forward earnings, and that's at a sizable discount to its freight duopoly partner, UPS. And this company, I think, is really trading at a sizable discount, especially after Friday's earnings. So we had a knee-jerk reaction following a miss on the bottom line. And this miss was not something systemic. It was some retirement plan accounting changes. There's some adjustments for the retirement plan, the market-to-market plan for all of their pension funds and whatnot. And we also had some continued integration costs from their TNT Express acquisition. And this TNT Express acquisition has actually been a huge weight on the company since it was announced back in 2018, and TNT Express is effectively, FedEx in Europe. So they were trying to branch out their operations to international prospects, and unfortunately, this company had pretty bad margin compression, and this pandemic did not help. So that's why we had a huge drop off since 2018, but we are finally coming back into the green. And today we can just see it. We can see the FedEx buyers coming in and swooping up this stock. Even as UPS drops off an over 1% cliff, FedEx is trading buoyantly. And it's because the markets realize this stock is actually undervalued. And we're seeing large buying volumes today. So let's take a look at the charts, take a look at where the stock's trading and why the record revenues in this past quarter are going to drive the stock continuously higher in this rapidly digitalizing world that we're living in today. So this is FedEx chart on tradingview.com, and you can see the stock has had some volatility over the last few years, and this is due to its 2016 acquisition of TNT Express, which is now its European subsidiary. And that company has kind of seen some margin compression over the last few years in Europe, and it's being reflected in FedEx's stock. It's been a huge dead weight on the company, and it's led the stock lower ever since the beginning of 2018 and to our pandemic lows of less than $90 a share. And we have since then boomed, over tripling in price, and we are headed higher off of this past Friday's knee-jerk reaction, which led to an over 3% to 3.9% drop off. You can see that we were even lower earlier in the day on Friday, but we closed at a nearly 4% drop. Today, we are remaining relatively buoyant compared to the broader market. You can see that the Nasdaq is leading us, but we have the Dow Jones falling, as well as its duopoly partner in the freight business, UPS. It's fallen 1% today, but we have buyers right now in FedEx that are keeping this thing buoyant. You can see it looking at a chart here. We have some pretty strong volumes coming into today as people realize this value trade in FedEx. We have a digitalizing world where we're headed towards more and more e-commerce, more and more online buying, which is going to have package delivery demands, continue to thrive in this post-pandemic new normal. And looking at it compared to UPS, you can see that we are trading at a huge discount to its, like I said, freight duopoly partner. And this is an opportunity to jump into this stock. We're trading below not only its 5-year average or its 5-year median, but like I said, below its biggest competitor. So I think right now is a perfect opportunity to buy this stock as bulls drive this thing back up to an equitable price. I think that this knee-jerk reaction on Friday was overdone, and you can see a lot of that, from opening, we came back up in the second half of Friday, and it's because this stock is undervalued. Analysts are getting increasingly optimistic about FDX, raising their EPS estimates despite this earnings miss that we had on Friday. Analysts are continuing to drive up their long-term EPS estimates in this digitalizing world as the necessity of FedEx becomes increasingly valuable. And you want to be a part of this company at this discounted rate that we are trading at today. Want to buy stocks on sale, and despite tech taking over the trade, it is good to buy cyclical stocks on a dip, especially ones with strong fundamental backings and discounted valuations like FedEx. So don't forget to check out Zacks.com/promo. We have the rebound of the century. We've got 8 stocks poised to blast higher on this $4 trillion travel recovery. Thanks for watching, guys.